Recently, Mary Daly, a representative from the Federal Reserve, sent us an update this morning. She always makes sure to talk our market down as soon as it gets green. So we have a few things to discuss. And so, this is Investing Path. And for today's video, we will discuss not just the ludicrous concept of deposit insurance system, or simply the opportunistic disinflation. But before we go on, please make sure to give this video a thumbs up and make sure to hit the subscribe and bell button to see more of our future uploads. But other than that, let's begin. First, Mary Daly emphasized the Federal Reserve's stated goal of 2% inflation, stating that more rate hikes are necessary, and from where they are now at 2% to where they need to be before they can consider their work complete is 2%. Now they're saying that dislocation in the market is possible, but they're still planning to raise interest rates. We may beat away at minor issues as they arise, but ultimately we'd be headed in the direction of ensuring that interest rates rocket to the moon. Inflation was sky high throughout the 1980s and 1990s, and it's clear why. Lately, Paul Volcker ended up raising interest rates so high that they were higher than the nominal rate of inflation, and as a result, we were able to bring inflation down to around 4%, when compared to the steep decline from above 15% to below 4% over the course of just 5 years. This rate of inflation seems almost tame. It took the Fed 15 years to get interest rates down from 4% to 2%, but now they're taking action in a way they weren't before. What we're hearing today is that we'll be fine in the long run, but in the short term, we're going to keep turning down inflation until we get to 2%, and we're not going to stop until we do. The market and our expectations for future inflation have both fallen as a result of this. Perhaps we are being manipulated. It's not out of the question, for example, that inflation of 4% actually occurs. Meanwhile, the disadvantage is the world stock market selling. If you check at Webull, you'll see that there are up to 12 free stocks available. But again, on the Nasdaq, Tesla is down 5.5%, while Ape is down 10%. This is bad. You're experiencing discomfort. Yet, there is some good to be gained from it. Take a look at this. It's a chart showing 5-year break-evens, and you can see how low they've fallen if you look at this side. We have fallen significantly from our 2016 levels. Can you believe that a year ago, we were just freaking out about Delta when we had the Delta fears? Just take a second and consider how much time has passed since this time last year. Oh wow, it's been a year since Delta. A year since a lot of things you realize. You're aware of this. And we might add that Omicron initially appeared in January of this year. It is worth noting that everything that has happened is absolutely insane, but watching inflation expectations fall to such low levels is fascinating. And the reason inflation, like actual inflation, usually follows this is because the Fed is being so active right now. This is excellent, but it happens with a big lag. Even though inflation expectations are currently at their lowest levels in the past year, which could lead to disinflationary shocks. On the meantime, we are not, by any stretch of the imagination, at the very lowest levels possible. In fact, we have been at even lower levels. If we look back 5 years instead of 1, we may see that the anticipated significant disinflation, if not deflation, occurred during the COVID epidemic. That was mirrored in people's expectations, naturally, since we believed the economy was going to collapse. If we draw a line from our current position, however, we can see that we're essentially in the same place that the electorate was in December 2020. And if we look back, we're just around where we were in the 2017 to 2018 cycle in terms of inflation expectations, which was partially because the Fed was still attempting to tighten and raise rates in 2017 and 2018, but the markets were still panicking. What did the Fed do in response to the precipitous drop in inflation expectations that occurred in December of 2018? We basically did a 180-degree phase and restarted the money printing machine. They flipped the switch when they saw how our hopes were crashing so dramatically. After the Omicron raise gave us the Delta raise, that doesn't belong there. January is in Delta, and this is in Omicron. This is a recipe of war, and it's clear that our expectations have fallen as a result. That's fantastic news, since it suggests that lower inflation expectations are being driven, perhaps by a Fed that is just talking down to us. But the issue is they are making it so plain that we won't stop until we reach 2%. before they reach 2%, they will wipe out, or may have already done so, any chance of you turning. That's unsettling because the Fed never did this in the 80s and 90s. The Fed may be making a huge mistake if they do this, so it's important to consider all of the possible outcomes. So let's assume they start smashing things and then they have to do a U-turn. Now, the Fed's credibility has been damaged even further, and less people will put their faith in them, because they know they won't be able to count on them to halt until interest rates reach 2%. The optics of what they're putting up will be dreadful if they make an early U-turn. So if you detest poor people as much as I assume you do, you'll stop at 5%. They may easily push us into a horrible despair if they don't turn around soon. However, the market is showing far more aggressive pricing. Not wrongly, they're anticipating rate hikes because every prediction the Federal Reserve has made thus far has been completely off the mark. As of now, there is a likelihood that we will be at 4.5 to 4.75% by next summer. You can observe the escalation of that possibility shortly after the Fed meeting. The closer we approach the date in question, the more plausible these ranges become. And as this chart rises, the stock market falls. If we change the range to say 4.75 to 5, you can see the aforementioned instability, with the likelihood briefly rising and falling. Stock market fluctuations are mostly attributable to the ups and downs. This is why we would find out the odds of us landing anywhere between 4.75 and 5. For a large chunk of time in the preceding months, the market may have implicitly priced in at 0% chance. However, after hearing feedback and reports this morning, we have adjusted yesterday's pricing to a 21% chance. It's bad that this will likely recur when we get to the data that begins populating for today. Unfortunately, these peaks are generally followed by ugly candlesticks to the downside. The Nasdaq saw 2 consecutive days of heavy losses, falling by about 3%. You can see then how the stock market and, sadly, job losses are correlated with this anticipated future interest rates. The worry of these subsequent events and the numbers we saw this morning aren't helping. Like, we keep expecting that to decrease and, restrict some of the issues we are having with the Fed, but it hasn't. The unemployment rate is predicted to remain unchanged at 3.7% in Friday's report, and 0.3% growth in average monthly wages is also anticipated, and the projected number of employment has dropped to 263,000 from 315,000. However, the issue here is the shift in non-farm payrolls 263. The figure isn't particularly high, so we think it'll be easy to overlook it, at least in terms of the positive side. And the likeness of these events will fall more if the aforementioned report indicates 300,000 new jobs have been created, as the Federal Reserve will likely respond with, "Alright, our work isn't even started. Let's simply keep increasing." If the Fed continues to close the door on opportunistic disinflation, that is, waiting for opportunities to let deflation go down, then interest rate curves and the stock market will shift. Instead, they're actively working to reduce inflation. As for now, let's just hope for the very best. And that's all we have for you guys today. Thank you so much for watching. If you have any thoughts about this video, feel free to share your insights in the comment section below, and we'd be more than glad to join in the conversation. But besides that, and before you go, please make sure to give this a like, subscribe, and hit the bell button as well for more of our financing content. Once again, this is Investing Path, and we'll see you on our next video.